start to talk about this idea of temporal validity. And I wonder if you can just describe what you mean by that, and maybe tell me if my intuition's right, that it connects to just in general the idea of robustness and how we think about trading strategy.
Yeah, temporal validity was a concept, and it's really from the social sciences, from psychology, that I only recently stumbled upon in some of my readings 2-3 years ago. But it caught my attention, particularly from a systematic trading point of view, and the failures and successes that we're all going to have, and the somewhat randomness of what we have. Data is very noisy. The signal that we can extract from it is not very large compared to the noise in the background. And so while we can create and best craft our strategies and our portfolios based on what's happened in the past, and we are, being systematic traders, expecting many of those tendencies to continue, but we have to know that the future it's going to be bumpier. It's going to be noisier in the future than it was in the past. And so the idea of temporal validity really caught my attention as an ability to do a study and have a result that not only stands up in that moment of time that you're performing that study, but as small characteristics change in the sort of microcosm of the data or the background of whatever you're studying. And again, whether this is finance, psychology, medicine, how robust are the things that you're finding, and will they be robust subject to small changes over time that are going to happen? Markets change, markets evolve, participants come in, they trade differently, they change the way signals are going to behave to their trading. And while we've got core beliefs and core strategies that we expect to continue, they're not going to continue exactly as we expect. And we want to build portfolios of strategies that, even though the future will be a little bit different, it should still hold up relative to what we've seen in the past, our results.
So there's 2 or 3 things in there that I want to pull on. So one of the dimensions of this idea of temporal validity is that a strategy will persist through time. It's consistent in time, and it is likely to persist in the future out of sample, right? So there's this idea of, how do we evaluate whether a strategy is still relevant out of sample? So I don't know if you have anything new or interesting to say on that. For us, that falls into the category of a hard problem. Over certainly 4 strategies that are traded at frequencies that most of us are familiar with, right? At sort of anything at or greater than a daily trading horizon, the evaluation of out of sample performance relative to in sample performance, just due to sample size, I think is a hard problem, right? Yeah. So I'll throw that over to you. I wonder if you have anything to say on that.
Sure. And one of the actually the first topic of the portfolios piece that I published is that you should expect your signal to decrease over time. And the stronger it is, the better that you see it, whether you found something that's no one else, you're able to access a market in a way that no one else has. People are smart. There's a lot of really smart people looking for edge. And sooner or later, they're going to start to dig into it. And it likely won't decay to zero overnight. But the stronger it is, the faster it's going to decay. And that doesn't mean that everything is going to go to zero eventually. I mean, I think because we're competitive as a group of people in finance looking for these edges, eventually once some of these signals have degraded, money starts to leave it. They start to chase the hot idea again. And so there is kind of some baseline of where strategies ultimately trough, if you will. But if you found something that's very effective, you need to monetize it. You need to trade it. You need to take advantage of it and expect that over time that signal is going to degrade. Now, to your point, how do you exactly measure that, and what's the expectation? That's very tricky, and I have yet to find something perfect to describe mechanically that expected deterioration of edge. But you got to figure it's out there.
Yeah, or even just measure it, right?
Yeah.
I mean, it's one thing that you've got a neat chart in your paper that sort of, I think, plots a theoretical decay function, right? It's sort of like theoretical alpha decay function. And so a strategy starts out being unheard of. It probably has limited capacity. If you really want to preserve that really strong edge, it leaks out, it becomes known, papers get published, it sort of enters the belly of the curve. It's still relatively attractive. It enters the domain of your typical 2 and 20 hedge fund. They're seeking both performance and capacity. And eventually it enters the mainstream, the sort of zeitgeist, the Overton window, and it migrates into this kind of smart beta commoditized version. And it sort of it's asymptotic to whatever that baseline edge might look like, right? Yep. So I think that's a reasonable framework to think about the evolution of trading edges over time. I also, it's an endless curiosity for us as to how to think about evaluating. I mean, one of the things that you identified in your paper, which we've spent a lot of time on, is that the marginal benefit of diversification, it decays fairly rapidly, right? So you keep adding new strategies, but every new strategy that you add has diminishing marginal utility. And so if that's true, then there comes a point relatively quickly, actually, where it pays very substantially to be able to identify which strategies are likely to outperform others and just sort of, remove the ones or substantially de-emphasize the ones that you think are likely to have decayed to a meaningful degree, and then emphasize the ones that obviously you've got greater confidence in. And to be able to wrap some kind of quantitative framework around that, to measure that, is, I think, an ongoing question. So, if you don't have a solution to it, then, I'm not surprised, because I don't think I've encountered anyone with a holy grail on that. No, and that was, a very eye-opening result of mine. And, look, when I write these papers, a lot of it is the conclusions I found, which very often are eye-opening for me, and I just like to share, because frankly I get back so much from people like yourself and others. But the one to me was diversification, and the fact that it's the free lunch, the only free lunch that's out there, and absolutely true. But the benefits, and there are some remarkable graphs in there, decay very, very quickly, particularly when the one example is if you've got strategies that each have a correlation with each other of 0.5. By the time you get to 7 or 8, you've pretty much hit that asymptote of how quickly or what extra benefits you're going to get. And if you're going from 7 to 8 to 50 strategies, you're probably better off spending your time finding something, either taking those top 10 strategies and making them better, or looking for something not correlated, as opposed to going to your 10th and 20th and 30th strategy with very high correlation among each other. It just doesn't add up. That it's not worth it. And I think the paper brings it up as a theoretical idea from, if you are a systematic manager and you need the new research for the new strategies, where do you want to spend your time? You need to think about what you've got and what the value add is going forward of edge or alpha versus correlation to your existing portfolio suite. Yeah, and the other side of that, of course, is that if you can legitimately find strategies that are uncorrelated, so have a zero correlation, then that point of diminishing marginal utility is surprisingly far out in terms of the number of strategies that are still materially accretive, right? You can get into the sort of 20, 30, 40 strategies, and where that marginal extra strategy is still may add a creative Sharpe ratio even at the margin. So the difference between 0 and 0.1 is average correlation is way larger than people might imagine intuitively, right? Yes. Which I think is an interesting. And again, anyone who says I've got 50 strategies that have absolutely no correlation to each other, I'd be curious how that happened, or what their experience was the past 3 to 4 months. Because again, in normal times, maybe, but correlated factors, correlated sort of risk among assets that look very different can pop up, and unfortunately at the worst time. Yeah, it's hard to really dig into the conditional correlations of all of these strategies as well, right? So they may look uncorrelated on average, but just as a really accessible example, stocks and treasury bonds, right? So on average, over the very long term, they've had a correlation of 0, but they go through multi-decade periods where they have a negative correlation, and then another multi-decade period where they have positive correlation. And so you need to be aware of the correlation dynamics at each point in time in order to be able to fully take advantage. So it requires a dynamic approach to that in order to maximize the diversification. So we sort of discussed one dimension of that idea of intertemporal validity, but you did sort of bring up another, which is kind of not so much temporal, where temporal refers to time, but is still a dimension of robustness, which is sort of perturbing the specification of the strategy, right? So a strategy needs to work in different economic environments or at different points in time and be fairly persistent, but it also needs to be resilient to small or even sort of moderate changes in how the strategies are specified, right? The parameterizations of them. So would you include that? It's your idea of intertemporal validity, or, is that something different?
Yeah, no, absolutely. And part of, I would say, the culmination of my research or philosophy was to better classify strategies than just call it stocks, bonds, and alts. I'm exaggerating a little bit, but you kind of get the idea.
Yeah, for sure.
And the idea there being is, as these alternative risk premiums pop up and more inter-asset asset class strategies come to life, we can't just say they're long, short, they're flat. Let's just put them in a bucket altogether. I would say probably the best example of that is even managed futures and trend followers, which had such a great run in the great financial crisis of 08 and 09, and a great diversifier of not only protecting capital when equity and risk assets were in the very strongly going the other way, but actually making a fair amount of money. So fast forward, through 2010 and the backward hindsight capital mirror, more and more allocation goes into these products, into the trend following products, with the expectation that if something happens to risky assets, they will perform very, very well. Not just uncorrelated, but anti-correlated, if you will. And we get to coming a little closer to the here and now, February 2018 in Volmageddon and the very sharp sell-off in the S&P 500 in equities, and trend followers, generally speaking, didn't quite perform. And the answer is they probably shouldn't have. You had a market that was nearish highs with long exposure, as they should be from a momentum time series momentum basis. And while they didn't get crushed, they didn't provide the diversification value that they did in 2008, 2009. March 2020, the same thing. You had such a strong and swift speed of the sell-off that it took time for signals to flip.